Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Israel has confirmed the beginning of a targeted ground invasion, or at least raids, maybe that is more accurate, in Lebanon. The Israeli Defense Force saying that its troops have begun limited, localized, and targeted raids against Hezbollah targets in the border area of southern Lebanon. Let's bring in for a closer look Bloomberg's Derek Wallbank. He is our breaking news managing editor. He is on the line from the Lion City of Singapore. Derek, this is kind of interesting because this ground raid action was pretty well telegraphed by the Israeli government, was it not?
Yeah, it was, and it's come as there's been some question about whether or not Israel is going to move in with a full-scale ground invasion. This is sort of short of that, right? The Israeli government going and taking some pains to say that this is targeted, that this is acting on specific intelligence. It comes after Israel successfully killed Hezbollah leader Hassan Nasrallah on Friday, and so there has been some, I think, progress that Israel has made that it feels, for lack of a better word, that it feels good about, that it feels like it's finding success against Hezbollah in ways that it has been unable to in recent years. Israel has set a target of saying that it wants Hezbollah to not be able to launch rockets into northern Israel as a sort of condition. Hezbollah's new leader saying that they are prepared to continue fighting.
Is Israel, Derek, using this series of actions to actually crush Hezbollah and possibly Hamas afterwards? I mean, it may not have been something they thought about a year ago, but the message seems to be that they are, pushing forward hard.
Those have been the conditions or something like that Israel has set out as a condition of success, right? I think it's very important when you're talking about armed conflicts, be it between two states or between a state and a major actor, as this one is, to really pay attention to what the leaders are openly saying are their conditions here. And in both the cases of Hamas and in Hezbollah, Israel has said that it wants to essentially change the status quo. It does not want to have an effective built-up opposition that is capable of the sort of attacks that they've been able to do. Now, the counter to that, and I think that one of the things that the United States and other friends of Israel have been trying to make the case about, is that if you go and prosecute those conflicts and actions to a certain degree, it will not just accomplish whatever you think that it's going to accomplish right now in terms of the present enemy, but it will also build a new enemy by people who are so mad about what you have just gone and done, and thus the cycle begins again. And so I think that is one of the present risks that the United States has been trying to warn Israel about. Remember, after October 7, Joe Biden famously warned Benjamin Netanyahu about Hamas, that, of the U.S. experience in Afghanistan, right? If you sort of go after in a way that you start with target, but then you expand beyond, sometimes you can expand it and cause yourself more problems than you had wanted to go. And so the U.S. has tried to play a sort of restraining factor here. You did in the pre-roll of this, flagged audio of the U.S. saying something as much that this latest action against Hezbollah to the north, has been less than what maybe Israel had originally signposted it wanted to do. We'll see sort of if that is where this ends or if this is an intermediate step towards something more.
Well, to that point, have we heard anything from Hezbollah about retaliation? Have they made a statement?
Well, their comment so far that we have is that they are able and willing to continue to fight on the ground. So that's sort of where that is. But as I say, it's a very fluid situation. So let's see where this goes. If this is one step, or if this is what is going to happen, and then let's see what Hezbollah's reaction is going to be. Certainly, recent attacks by Israel, recent operations by Israel have severely cut into Hezbollah's abilities.
And doesn't that mean that the ultimate bogeyman is Iran and the Iranian leaders now? If they can get Hassan Nasrallah, they can get us.
Well, and the question that you do have to ask if you continue down that road a little bit is, how do you stop this from being an all-out fight between Israel and Iran? Right? That sort of conflagration is the thing that I think that the U.S. and others are really concerned about, is that whatever this is, that it not become that.
So we're very close to a critical state.
Thing.
Yeah, no, we're close to a critical state. I mean, even if perhaps we're there already. Derek, thank you so much. Derek Wallbank, Bloomberg Breaking News Managing Editor, joining from Singapore here on Daybreak Asia.
Kristina Hooper, Chief Global Market Strategist at Invesco, to join us on the program. Kristina, thank you for joining us. Powell's comments ruffling a few feathers there. I suppose some people might be thinking that the difference between 50 and 75 basis points is not all that great. And it might also be that, you don't want to really overthink things. The Fed is cutting and growth is fairly solid. How did you see his comments?
I think they were very appropriate because markets were getting a little too excited that easing would unfold very, very rapidly. And Jay Powell certainly wants markets to be positive, but he doesn't want just an overreaction. And he wants something that's gradual. He wants something that is not overly effusive. And so I think it makes sense that he talked down market fervor. But again, the Fed is headed in the right direction, and we're looking at on a very significant easing cycle.
Yeah,
if we go...
I'm sorry.
Go ahead, please.
No, you're making a very interesting point, which is we know what the path is. It's kind of what Brian kind of laid out as the foundation. We know that rates are going lower. We know that the American economy is holding up reasonably well. Inflation is coming down. So maybe what the chair was doing today was addressing the financial conditions that he would be concerned become overly loose at a time when they really need to make sure that inflation is no longer the problem that it once was.
I think that's exactly right. While inflation is now in the rearview mirror, and I think the Fed is fairly comfortable with where the U.S. economy is going, let's face it, he doesn't want an overreaction on either end. And so I think he needs to keep markets in check. But I think this is a very positive environment for markets. And I look back to 95, 96, the last time the Fed entered an easing cycle after tightening and avoiding a recession. And that time we only got a very, very shallow 75 basis points in easing. We still saw GDP growth improve really significantly soon after the Fed ended its easing cycle. And I think we could see a very significant reacceleration in growth if we get this more powerful easing cycle.
We note that the two-year yield is actually now higher than when the Fed cut rates by 50 basis points. But I think if you look back to July, the yield has come down pretty rapidly from 4.75% to the current 3.64. So this is an example of how the market got out in front of the Fed, and the market was acting perhaps a little bit too aggressively, in your view?
Absolutely. And we have to assume that is going to happen again. I mean, this is very much a part of the recalibration of monetary policy. There are going to be periods where the market gets ahead, and then it takes someone like Chair Powell to rein them back in. And so it's a little dance that's done, but it is very much an easing cycle that I think is Very significant. And again, it's not just the U.S. So many economies are embarking on easing right now at the same time. And I think they're looking out on pretty significant monetary policy loosenings. So this is good news for markets.
I think the case of China is remarkable in terms of easing. Give me your assessment of how you evaluate the stimulus package that has been unleashed lately by the Chinese authorities.
Well, let's say this evaluation is a work in progress. We certainly know the kind of stimulus we're getting on the monetary policy side, and that is very, very significant. I think has the potential to be quite powerful. But what we've learned from recent history is that typically monetary policy stimulus works best when it comes with some fiscal stimulus. And we have the potential for that too. And so I'm very excited. I'm looking for more details, but certainly this has, I think, the very real possibility of impacting the Chinese economy in a very positive way, putting it over 5% growth target.
Let me ask you something that might sound a little contentious, but both you and Doug kind of suggested that the Fed was concerned about financial conditions easing too much. So basically looking at the market, feeling uncomfortable with gains. But when you see where the Fed funds rate is in comparison to where inflation is and where growth is, I mean, shouldn't that be what they're looking at? That's more meaty than the ups and downs of a market.
Well, you make a great point. I think they should have been looking at it a lot more carefully before they started easing, because we did see very restrictive monetary policy. It's obviously gotten a little better, and I think it's going to continue to get better. And let's face it, the Fed has to have eyeballs on a lot of different metrics, and it is very much a balancing act. But I do believe that even within the Fed, there are some members that are certainly good cops, and there are some members that are bad cops, and they make it work. Although at times it can seem like a cacophony of voices.
Kristina, as you know, we have the employment data on Friday. That may be the main event of the week, although tomorrow we do get data on job openings. How do you understand the American labor market right now? Is it really softening, or is it kind of more stable than soft?
It's definitely softening, in my opinion, but I would characterize it as more appropriately termed normalizing. It was incredibly tight. In fact, not to go back to 95, the 94-95 tightening cycle again, but when the Fed started doing that, unemployment was above 6%. Of course, we had unemployment at the unemployment rate at a much lower level. So this is an extremely tight labor market. And so this little bit of softening is more normalization.
Just briefly, to put your global hat on, do you buy China here or no?
I think China looks very attractive, and I think it's looked attractive for a while because of valuations, but now we have the catalyst. We have this very significant stimulus. So I think this is an attractive time. There are legs there.
Yeah, it's interesting. In the last quarter, the rest of the world has outperformed the U.S. and the equal weight has outperformed the S&P 500. So, yeah, maybe it's time. Maybe it's playing out right in front of us. Kristina, thank you so much for joining us. Kristina Hooper, Chief Global Market Strategist at Invesco. Andrew Slimmon, Senior Equity Portfolio Manager at Morgan Stanley Investment Management. Fed Fund futures see the Fed funds rate at about 3.02% this time next year. That's a long ways from around 5% where we are now. Can you get there with 25 basis point moves?
Well, good morning. How accurate has the Fed Fund futures been over the last year?
Yeah, well, the question, I guess, really is the way I put it last time was, which is it's either that the market is way out in front of itself or that the Fed is behind the curve.
I think that the market's way out in front of itself because we watch the Fed Fund futures and expectations of rate cuts, and they, on a weekly basis, and they are constantly flip-flopping. And the market was way too optimistic the Fed would start cutting before they did. And now I think they're too optimistic the Fed will cut more aggressively than they are. And I think I agree with Jerome Powell. They'll take it slowly. And I do find it interesting that yields have gone. Now, I'm an equity manager, but I noticed that yields have gone up since they cut rates in September.
Andrew, do you have to kind of re-examine your thinking if the employment data at the end of the week is on the soft side?
Well, I mean, I think one of the things that worries me is that I think we are in for a soft landing, but that's now consensus. What you see worked from a equity factor. What worked in the market in September was high risk. It wasn't about value growth, broadening out, none of that. It was about the more risk you took in the stocks you chose, the better you did, which implies as we're coming into October, there's a pretty high level of optimism that we're going to have a soft landing. And so the setup is not good going into that labor, number. If in fact it's weaker than expected, then you could have a more substantial pullback because risk has been chased this month, and that's a dangerous thing.
So the thing about Mark is they tend to discount quickly and do get out in front of themselves. You just mentioned an example where 2-year yields are actually higher now from when the Fed cut interest rates. However, they are down over the last 3 months from 4.75% to 3.63 here at the moment. So it's kind of an example of the market getting out in front of itself. So I sort of feel like it's a good time to be confident now, except for valuations. So are you confident? Can you go long this market now?
Well, I think within the market, there's great opportunities because again, I told you high risk worked, but what also worked in September were the companies with the worst earnings revisions. So I think there's a lot of short covering of stocks that had done the worst fundamentally and therefore their stock prices. So they were the ones that bounced the most. Highest risk, worst earnings revisions. And we're coming into earnings season. And the result is that the stocks that lagged were actually the companies that have done well year to date because they've had the best earnings revisions. Now we're coming into quarterly earnings, and I think that's a great setup for companies that have actually done fundamentally very well this year. They lagged in September. And I think that's a great setup for them to remind people why they're doing so well. And likewise, the risk is people say, oh, okay, well, maybe, the great China recovery won't turn these consumer product companies as quickly as I expected, things like that have had the biggest rally. So I think it's a great setup for finding companies that have the best fundamental story because they've lagged over the last 30 days.
Well, you mentioned the great China recovery there. I think that what we've seen in market action smells to me like a massive short covering, a squeeze of sorts, right?
That's exactly right.
So do you have maybe the stomach to put some money to work in China right now, or there's just too much uncertainty still?
I think the best opportunities actually in material stocks, like in Japan, the commodity exporters that got hit when really since this summer when the yen stopped depreciating. But as you look at, when you think about China and if the economy is going to recover, I think you're going to see commodity prices actually levitate, and that will help a lot of these big commodity exporting companies out of Japan. I'm more confident in that than I am to say, hey, the luxury stocks in Europe have bottomed because the Chinese consumer is going to come back in waves, which has really hurt those companies. I'm more confident in the commodity rally taking hold than, say, the consumer turning around. Either it's French luxury or cosmetic companies in the U.S.
So you wouldn't be a buyer of some of these beaten down property names then?
Well, I'm not a emerging markets manager. I'm a developed markets manager, and I think Japan offers a great opportunity because these stocks have really pulled back quite a bit, in the last 3 months.
So I'm curious about anything. You mentioned Europe there, whether there's opportunity that you're seeing in European companies that may be exposed to the U.S.
Well, exposed to China, I think more so. It's just I'm less I'm not as optimistic as the market has been over the last week about the consumer-oriented stocks. But I think the material stocks that benefit immediately from higher commodity prices, I think that's a better bet than the consumer has truly turned in China.
We had a guest on yesterday, and we were talking about if the Fed is going to continue cutting interest rates, even at a slow pace, that the dollar might weaken from here. And the guest had some comments that yes, but, and the but part was that the euro doesn't seem like it can gain a lot against the dollar because of conditions in Europe. And, you have some problems with the yen as well. What are you thinking about the dollar going forward?
Yeah, I think that's right. I mean, I'm an equity manager. I'm not a currency specialist. But whenever anyone says, well, the dollar is going down, my first question is always, so what currency exactly do you love because you think the dollar is going down? Yeah. And so I think it's, I understand the Fed's cutting and they're cutting more aggressively. And maybe the dollar weakens, but I don't think it's catastrophic for the dollar because I don't see other currencies really stepping up and being very powerful.
All right, Andrew, thank you very much for joining us here on the program, for taking the time, particularly this late. We do really appreciate it. Andrew Slimmon, Senior Equity Portfolio Manager at Morgan Stanley Investment Management. We say good morning to Sandi, who's Chief Client Officer at Aspiriant, joining us here live on the program. Sandi, Fed Fund futures are at 3.02% this time next year. Now, that's a long way from where the Fed Fund future or where the Fed funds rate is now. So my question is, either the market is out in front of itself or the Fed is behind the curve. Which is it?
Hi, Brian. We think the market's doing pretty well. We're pleased. The Fed's done a really great job of avoiding the long-feared recession, and we think with the recent decrease in the Fed funds rate that the economy is going to get a little bit of a boost, and we see signs of growth in the months ahead. I mean, there's always room for risk, but we think the market's on track, and we think that the Fed will continue to decrease rates in the months ahead. Not sure that we're willing to bet on the pace of those rates, but that should also, regardless of how much we get and over what time period, it should help boost the economy a little more and pour into the growth that we expect.
Yeah, even with the drop in mortgage rates, right, and the refinancings that have been happening, that's going to inject a fair amount of cash into the economy. So this is the final day of the third quarter. How well did we do, and what are we going to see in the earnings?
Well, we've been pretty pleased with the third quarter. We've really been diversifying our client portfolios, keeping some of the Mag 7 in the portfolios, but not necessarily to the degree in which it represents the overall S&P 500. So we've been very pleased with the comeback of small cap stocks, of value stocks, even of overseas investments. That's all been good news for our portfolios, and we expect more of that as we head into the fourth quarter. We do think the earnings for the third quarter will be strong, and we expect earnings to continue in the fourth quarter for those reasons you mentioned, Doug. We're going to get a boost from the lower rates, the stronger housing market, and equity prices. All of that should support broad consumption, which should turn into good earnings reports for businesses here in the U.S.
With the unemployment rate moving from 3.4% to up over 4%, it does suggest something is afoot. How would you describe what that is?
I think it is just a transitioning of the economy. That's why the Fed was dropping rates to help support businesses. And we're not too worried about it at this point. We'll continue to watch the numbers, but again, with the support to the consumer, we think that things should balance out, and we should be in a pretty good glide path for the rest of the year. Although, as we move into the fourth quarter with the election around the corner, we do expect that to cause some volatility, and we have our eyes on the geopolitical events happening around the world that could also cause some volatility as well, though so far it hasn't really impacted the global economic situation in any big degree.
Speaking of kind of global economics, we've got a story in Japan with a new prime minister and a story in China that involves a massive rollout of stimulus. Are you looking at any of those markets right now? Are you looking at offshore opportunities?
For sure. It's been pretty exciting over the last few days. In the emerging markets, we have fairly strong allocations there. They've been so undervalued, the companies there, relative to U.S. stocks. So we've really liked India, China, Taiwan, Korea, and Brazil. And the developed overseas area, Japan, has been in favor in our portfolios. We do expect more good things to come there. And again, this is all coming on the heels of the U.S. stock market leading the world for so long. And now we are getting a little bit of softening in the economy, though, again, we expect it to be resilient. The decrease in the dollar has certainly helped those overseas investments, especially when the foreign currencies get translated back into dollars.
The CSI 300 has moved from about 3,200 to around about 4,000 now. So, obviously 25, 26% in a very short period of time, a week or so. Does that feel like too much, or do you zoom back out and look over the long run and say, well, it's just barely recovering a little of what it lost?
Yeah, I think that long-term view is really important, Brian. It is a big reaction in the short term to the favorable support, but we are bullish over the long term. There's just so much that the country is doing to support its stock market and to support its businesses, and it's one of the largest economies in the world. Long term, we're feeling pretty good about keeping allocations there.
Tomorrow in the U.S., we have the vice presidential debate. You mentioned the election and how it may produce a lot more volatility in the weeks ahead. Is it informing a change in investment strategy for you right now at this point?
It isn't for us. We really take the long-term view. So we've been encouraging clients, because we've been getting a lot of questions from our clients, or corporate executives, family business owners, and entrepreneurs about how to think about the election and their portfolios. And our perspective is that there's often too much weight given to political outcomes when it comes to judging investment prospects. So we're focusing our clients on the economy, interest rate, valuations. We think it's much better to focus on those things rather than who's sitting in the Oval Office. And if you look at the long-term data, long-term equity returns have been remarkably consistent regardless of election outcomes. So we're really encouraging folks not to get too caught up in the politics, so to speak.
Sandi, thank you so much for joining us. Sandi Bragar, Chief Client Officer at Aspiriant.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.